in my view that the 4-year cycle does not apply in this particular circumstance. And how I got to that point was they said, okay, let's look at the 3 4-year cycles in the past, 2009 to 2013, 2013 to 2017, 2017 to 2021, 21 until the present moment. And can we find any patterns that sort of, roughly rhyme with each other? And obviously I have my own worldview, which is all about the quantity of money. How much fiat is there in the world? And I believe that Bitcoin specifically, and obviously crypto more down the line, is a reaction to the amount of fiat that has been created, especially since the global financial crisis in 2008.
As Bitcoin hovers near the $100,000 mark, the market faces a turning point, where old halving theories collide with a new era of macro-driven momentum. Arthur Hayes, the co-founder and former CEO of BitMEX, believes the traditional 4-year Bitcoin cycle tied to halving events no longer fully explains market behavior. Historically, each having reduced Bitcoin's supply, triggering rallies through simple supply-demand dynamics. However, with the entry of ETFs, institutional investors, and macro-driven capital flows, Bitcoin's price movements have become increasingly shaped by global liquidity rather than block rewards. Hayes argues that monetary policy, credit expansion, and liquidity injections now play the dominant role in defining Bitcoin cycles. Echoing this macro perspective, Bloomberg strategist Mike McGlone highlights that market sentiment is shifting toward cautious optimism as monetary easing begins to take hold. Still, he warns that the backdrop remains fragile. Despite equities maintaining strength on stable earnings and technical momentum, widening disparities across commodities, notably gold's 53% surge versus industrial weakness, signal potential economic stress. McGlone is particularly watchful of Bitcoin's weakening momentum relative to gold, with the BTC-to-gold ratio hovering near critical support around 25x. He cautions that Bitcoin may revisit 5-figure territory before regaining its long-term bullish trend, as evolving fundamentals, subdued volatility, and shifting institutional sentiment redefine the next phase of the crypto market. As the crypto landscape continues to evolve, one thing is clear: Bitcoin's future will be shaped less by history and more by global liquidity. What's your take on this shift? Share your thoughts in the comments, and don't forget to like, share, and subscribe for more market insights.
So I think that putting a definitive number on how long a cycle should be should never be done. You should always basically evaluate the circumstances and then make a decision and not be held to some sort of dogma that it has to be this way because it's been this way in the past. And because I get asked this question a lot, especially during Token 2049 a few weeks ago, I thought, okay, let me just do a little chart study, get my thoughts on paper, and sort of answer this question so I don't have to keep, answering it every time I speak about stuff. And so I wrote this essay about the 4-year cycle and my view that the 4-year cycle does not apply in this particular circumstance. And how I got to that point was they said, okay, let's look at the 3 4-year cycles in the past, 2009 to 2013, 2013 to 2017, 2017 to 2021, 21 until the present moment. And can we find any patterns that sort of, roughly rhyme with each other? And obviously I have my own worldview, which is all about the quantity of money. How much fiat is there in the world? And I believe that Bitcoin specifically, and obviously crypto more down the line, is a reaction to the amount of fiat that has been created, especially since the global financial crisis in 2008. And I don't believe it's a coincidence that the genesis block of Bitcoin happened in January 2009 during the depths of the bear market, at the time when the Federal Reserve, led by Ben Bernanke at the time, restarted quantitative easing, at least in the United States context. And by that point, had already indicated that after the $700 billion bailout, the TARP bailout, that the Federal Reserve would start on unlimited quantitative easing. The markets bottomed in March 2009, and then it's basically been up only, with some minor blips from then onwards. And so if you think about Bitcoin from the first cycle, 2009 to 2013, we not only have the United States printing money, we also have China, which embarked on one of the largest infrastructure spends in their entire history in the 2008 to 2011 time period. And I showed a chart of the government credit impulse, which is the rate of change of how much credit's being created in China. And you see both America and China were printing a fuck ton of money. And of course, Bitcoin, went up a lot. Obviously, if you were trading Bitcoin in the fall of 2013, you remember the 40-50% premiums in China. I know I certainly remember that I was arbitraging it in Hong Kong at the time. And then as sort of 2013, the end rolled around, I posted a chart. You see that bank credit and Fed liquidity kind of rolled over a bit. China was not creating as much credit as they had been. And that was the pop of the first Bitcoin bubble, the 1300, whatever all-time high was reached in December 2013. The next cycle was basically driven by China. So if you were trading crypto, I remember this quite vividly back in August 2015 is when you got the $135 wick on Bitfinex, which was, a fellow named Zhao Dong got liquidated for 6,000 Bitcoin. It was a quite interesting day in the markets. And subsequent to that, within a few weeks, the PBOC did a shock devaluation of the yuan, and that really kickstarted the bull market that ended in 2017. And so China did another massive stimulus program. If you traded Chinese equities, you remember the Shanghai Composite hit an all-time high in 2015. And this was due to all this apartment spending. They did a big housing program to pump housing, and they were also doing infrastructure spending. Now, at the same time as that was happening, the U.S. was kind of going in an opposite direction where the amount of credit was actually decreasing and the Fed was raising rates. And at a certain point, those two policies came into conflict as far as the Bitcoin price. And by 2017, that rally was exhausted and we got the $20,000 peak. And then obviously the subsequent fall. The next cycle was the COVID cycle, driven by COVID stimulus checks, especially in the United States, which is the largest government that participated in printing money to keep people locked in their houses because of the flu. China did not participate as much as other places around the world. So this is really a U.S. story. And we all know everybody in the United States got a few $1,000s of stimulus checks. They went on Robinhood, they bought Bitcoin, they bought a car, they did all kinds of stuff with these checks. And obviously we know what happened with the 2021 $69,000 Bitcoin price. Again, driven by quantity of money increasing during COVID. As soon as the Fed started to say, hey, hold on, there's a lot of inflation, we're going to telegraph to start raising rates in March of 2022. That was the peak of the market around that late 2021 time period.
When trust in traditional financial systems begins to crack, investors and nations alike start searching for what truly defines a safe haven, and Bitcoin is fast emerging as part of that answer. Arthur Hayes reveals that the world is only one political decision away from losing access to its savings, as confidence in U.S. Treasuries, long considered the backbone of global reserves, continues to erode. For decades, surplus nations relied on the dollar as a symbol of safety, parking their wealth in U.S. debt. But after the freezing of Russia's reserves in 2022, that perception shattered. Hayes argues that the shift toward gold accumulation by countries like China and Singapore reflects not a fear of inflation, but a growing concern over sovereign security and asset seizure risk. In the broader context of financial theory, this marks a distinction between safe haven assets and traditional safe assets. While safe assets, like treasuries, provide liquidity and low volatility during normal conditions, true safe havens, such as gold and increasingly Bitcoin, preserve value when trust in institutions falters. Hayes suggests that Bitcoin's role, though still influenced by liquidity cycles and Federal Reserve policy, is evolving toward that of a digital safe haven. As nations accumulate gold to shield their reserves, individuals turn to Bitcoin to protect personal wealth. Over time, he believes, these two assets may converge, redefining what safety means in global finance. Let's get back to the interview.
You are one decision away, one particular, Treasury official or government official, that's, whichever administration, away from not having access to your savings. Because what are all these treasuries that these countries own? It's essentially, I exported more than I imported, and I had to save this in some way, shape, or form for the future to buy commodities, to buy goods and services, right? And so I saved it in treasuries because the dollar is a reserve currency. All the marginal oil exporters all sell their oil in dollars. I need energy, therefore I own dollars, I buy treasuries. Cool, makes sense. But if I'm gonna wake up one morning and all of a sudden property rights mean nothing, and some politician decided they didn't like my country, or me personally, for whatever reason, and now all of a sudden I no longer have access to my nation's savings, and now I'm thinking about, how am I going to afford medicine and oil and foodstuffs? That's a fucked up situation. And so how can you continue to stockpile treasuries as your savings when you know this could happen to you? If it can happen to Russia, it can happen to anyone. And so what we've seen since February 2022 is sovereign nations hoovering gold. China, Singapore, these are the types of places that are like, okay, well, we have a massive surplus. Why own treasuries? We're going to own less treasuries than our trade imbalance would suggest we otherwise should own, let's buy gold. And that's been the story of gold. So it's not an inflation story. It isn't a debasement story about the dollar. It's a, oh shit, what happens if the US does to Russia, does me like they did Russia? And so therefore I need to buy gold. That's the story of gold. I think over the last, since the summer, this story has gotten even a little bit more pronounced. The big event that in my theoretical analysis, is the bombing of Israel to Doha was a wake-up call to the Gulf. Supposedly, if you're a good little boy and you priced your oil or your natural gas in dollars and you bought your treasuries and you bought the U.S. military equipment, then America's attack dog Israel wouldn't fuck with you. For Israel to bomb Qatar, the largest gas exporting nation in the world, and the United States either knew about it or didn't know about it, doesn't really matter. It just means that they can't control them. Then that's not good. Why am I kowtowing to America, which is unpopular with my people, and selling my energy in this currency that's deflating at 8 to 9% per year, subject to seizure whenever some politician in the United States feels like it for domestic political points, and I'm getting fucking bombed by Israel? Why do I own this shit? I see that as one of the major events. We're like, well, holy fuck. Number one, I need to have a new security partner. And you saw that with Saudi Arabia and Pakistan signing a pact. Number two, I need to start thinking about selling my oil in other currencies. And obviously, this is a trend that's been increasing. We saw the love fest in Tianjin. I think that was where the BRICS summit was, between President Modi, President Xi, and President Putin. The Siberia 2 gas pipeline deal was signed between Russia and China. So these countries are like, number one, I shouldn't sell my energy in dollars. I should sell it in gold or some other national currency. And number two, I shouldn't buy treasuries. I should be buying gold. Because number one, I'm getting bombed. And number two, I get my shit stolen. What's the fucking point? And so that's the gold story. And I think Bitcoin is still a credit story. And we'll see what happens with the Federal Reserve meeting today. But I think this recent drop in Bitcoin was more a wake-up call that there's a tightness in credit in the U.S. money markets. If you take a look at the secured SOFR, secured overnight financing rate, which is essentially a tri-party repo general collateral issue, you can get into the details if you want. That rate should not be trading above Fed funds. The 75th and 95th percentile of awards on those rates on certain days have traded above Fed funds. The standard repo facility, which is basically the Fed's ability to inject cash into the money markets to make sure they function properly, has been activated in meaningful sizes and over the past weeks. So money is too tight. The ample liquidity has vanished from banking reserves. That's why the Fed's going to stop QT. It's a quantitative tightening or balance sheet runoff at sometime soon. And I think Bitcoin is sort of just reacting to that, saying, okay, there's tightness of dollars. That's why it dropped, 10, 20% off of that, either the Trump-China tariffing, right? That's at least how I read the situation. I think that Bitcoin and gold will trade on the same sort of dollar debasement inflation story at some point. But right now, sovereign countries are not buying Bitcoin. They're going to buy gold. They know what gold is. They know that gold has been used to trade between countries since we've been in, for thousands of years. They're not going to lose their jobs buying gold to buy the medicine and the oil and the goods that they need from other trading partners. They could lose their job if they bought Bitcoin and it went down 75% and they couldn't buy what they needed to buy. So retail people like me, we buy Bitcoin. Sovereign nations buy gold. I own both. Distinct reasons, but they'll sort of blend together at some point. Why you should own both.
As global power dynamics shift and BRICS nations advance efforts to develop an alternative payment system to SWIFT, the structure of international finance faces a profound transformation. While political and technical challenges slow implementation, the broader message is clear: the world is moving toward monetary multipolarity. This diversification of settlement systems aligns with the same forces driving the rise of Bitcoin as a decentralized alternative to dollar dominance. As nations seek autonomy in trade and reserves, individuals mirror that pursuit through digital assets that operate beyond political reach. Bitcoin's appeal, therefore, lies not only in its scarcity but in its neutrality, a parallel network evolving alongside the geopolitical reshaping of global money flows. As the global financial order rewires itself, one question remains: will Bitcoin become the ultimate neutral reserve in a divided world? Share your thoughts in the comments, and don't forget to like, share, and subscribe for more deep dive insights into the future of money and markets.